Well, hello, it's Mark Albert. Thank you so much for being with me today. Today we're going to talk about mortgages. We're going to talk about applying for a mortgage. And in the application process, we're going to look at the impact that your consumer debt has, that your debt load has, compared to the amount of income you have. My hope is that these three illustrations we're going to watch that I already pre-calculated are going to help you understand how important it is to eliminate and reduce your personal debt to help you qualify for the house of your dreams. So the impact of applying for a mortgage, we're going to look at three illustrations. All of them, I've already worked through the math and implemented the stress test that we're all under when applying for a house. And the household income is $100,000. In each illustration, they have a different debt level of personal debt. They're going to put 20% down in each illustration, and the interest rate is 3.5%. So here's a family household income of $100,000. They financed the car, and so they've added $400. And so the total debt servicing ratio, that impacts it. So the ratio for qualifying, this is included in that, and that hurts them, the more consumer debt you have. Here's the interest rate they're going to get from the bank. They're putting 20% down. They got plenty of money. They have a good income. They got a little bit of consumer debt, and they can put an offer on a house for $565,000. And if they do that, I'll be able to get them a mortgage at one of the banks. Okay, so it's a really good situation here to get a house of that size. The second situation, and you'll notice the red numbers, they're the only things that change in the three illustrations. Same family, same situation. They've added more debt. They're spending more than they make. And so now they have a total debt obligation of $700 a month that they're committed to. And this time, they can only qualify for $510,000. So the last illustration, see that? $565,000. So you add $300 more of debt, and you can add, it reduces the amount pretty significantly. So let's take a look. They've added more consumer debt. Now they have $1,100 a month of debt obligation, and they can only qualify for $420,000. Now, that's difficult in the Greater Toronto area to get a house at that cost, I'll tell you that much. And this is not a condo, because if it was a condo, you'd have to add condo fees, and that impacts the total debt servicing ratio. So they wouldn't be able to qualify for a condo that expensive in this situation. So let's look at the three compared one to another. So the first one here, the second, and the third. Big difference. They went from $400 a month debt to $1,100 debt. And the difference of how much they can qualify, there's a $145,000 difference just by adding $700 more than what they had initially. So that's pretty significant. So what I say to us here is, if you have a dream and a desire to eventually buy a house, start planning now, spend less than you make, get rid of the debt, so that it helps you to be in a better situation, better position to get the mortgage that you want. So let's take a look at my guy here. My guy up here, he's got three debts. It's very burdensome. And these three debts, he's got to pay them off. He's got $1,100 a month, let's say. And then the lender, they get rich off of him. So he's got to work hard and pay that off. So you're better to spend less than you make as a pattern of behavior. Save money, pay down the debt, and it positions you to be in a better situation if you're not a slave to the lender on the consumer debt side. So it's a really important thing. If you do have questions about this and you'd like help to work through your situation, feel free to contact me directly. My contact information is below, and we'd love to help you. Listen, have a great day. I really appreciate your time, and thanks for subscribing or liking the video. Have a good day.